Hey there, thanks for tuning in. Welcome to Investing in Germany, and today let's continue with our dive into ETF series. In this series, I will be discussing about different aspects of ETFs and comparing it to different asset classes, risk and reward ratios, and finally ending it with an ETF portfolio. So let's dive into today's topic, ETF portfolio versus the mutual fund portfolio. So the mutual fund is an actively traded fund, which means that there are a lot of buys and sells going on almost on a daily basis by a team managed by a fund manager. So there is a big team working in the back end for the fund manager to analyze the sector, analyze the business, analyze the headwinds, tailwinds, and all other aspects which really affects the market, and then they make trade with an aim to beat the market. On the other hand, with the ETF, there is no fund managers, so the ETF tracks an index, and the index are adjusted only twice a year, so therefore there is not a much of an buying and selling that is happening within the ETF portfolio. This is one of the reasons why ETF is also called as a passive investment vehicle. The other important aspect of a mutual fund is also the annual expense ratio. So a mutual fund is tend to be costlier compared to an ETF in order to maintain it on an annual basis. For example, the mutual fund has an annual expense ratio of between 1 to 2%. If you compare that to an ETF, which is 0.2 to 0.6%, because there is not a lot of buys and sells, as well as there is not a big team really working in the back end analyzing the market and making those trades and so on. In order for the mutual fund to outperform the ETFs, so mutual fund has to make a lot of buy and sell. Collectively, this buy and sell should make sure that their appreciation is higher than the ETF or the index appreciation. So this is really critical and really difficult in a normal atmosphere, because the mutual fund guys, they have to really do a lot of trades, and sometimes they win, sometimes they lose, and then most of the time they typically lose, which is also why the mutual fund, they are really struggling to at least meet the performance of an ETF. So in this article, which is dated on March 2022, which is relatively new, reports that 80% of the fund managers are underperforming the index. The question will come on to the investor's mind that why not invest in those 20% of the fund managers who are actively beating the index. So the answer is, how do we know who was lucky to be in the 20% and who deserve to be in the 20%? Of course, there are several fund managers who are really doing well, who are really beating the market over the period of time, extremely long period of time. And there are also fund managers who are really getting lucky due to some trades that they made. So it is really difficult for an investor to really pick them up and trust them and invest their money into them. The reason why the mutual fund also underperforms the index is due to the environment they are in. So they cannot sell any index mutual fund, because nowadays it is extremely easy to invest in an ETF which tracks an index at very low cost. So they will try to upsell some trends, some theme like the future mobility, e-mobility, artificial intelligence, blockchain, crypto, etc. The mutual fund, they really try to suck you into their investment theme, and then they try to bring you into the environment of investments. So let's take an example here in a hot theme, artificial intelligence. We have Tesla, Google, Meta platform, all scratching the surface of the artificial intelligence. Yeah, of course, some may say that we are really deep into the technology. Some say we are just scratching. I am of the opinion that we are really scratching on the surface. We have not yet entered into the deep of the AI. So here, for example, the DWS, which is an arm of Deutsche Bank, they have created a mutual fund to track the artificial intelligence industry or the theme, for which they are asking about 1.580 of an annual cost. In addition, there will also be performance costs for the fund managers and so on. So this is not the only cost what you will have for the mutual fund. If you compare that to an ETF, which has an annual expense ratio of about 0.49, which is almost 1.1% cheaper compared to a mutual fund. So the question here is also that why not I spend 1% more and then invest in mutual fund, so that I get the alpha out of the mutual fund and I can create more wealth compared to an ETF. So let's have a look at how the mutual fund and ETF has performed over the period of time. So last 3 years, on an absolute term, we have a mutual fund doing 20.56%. This is the artificial intelligence mutual fund. So it is, on paper, it looks really good. It's not that bad. If you compare that to an ETF in a similar theme, artificial intelligence, you can see that it has made 36.17%. So the investors have not only paid 1% more to a mutual fund, they have also underperformed the ETF by around 15%. So there is no case for the mutual fund here in a theme. Of course, there are some themes where the mutual fund are really doing well, but then it is a matter of time when they revert to the normal, to the median, where they will underperform the ETFs. So be careful before selecting the mutual fund. Of course, ETF is also not the best option, but to compare between the both mutual fund and ETF looks like a much better place to be in compared to the mutual fund. So as an investor, you make a call. So thank you. Sit tight, enjoy the ride. See you in the next video.